He's not.
All right,
blowing his
our
nose,
kids.
he's eating. He's so
I've got some
relaxed.
peanuts.
Lee, show your sleeve.
Literally. What's that?
Get in the
I
bed.
don't know. I'm not sure what it is. I was told to put it in though.
Is that
That's
some
his
kind
Manchester
of like,
uniform. Were you speaking?
some kind of right?
I thought that was your
So-
impression. Anyway, Louisa, go on.
So my
Monty,
criticism.
hello.
I took some criticism after our last thing, suggesting that there was no Scotland in my world. So what I did do is, as you can see,
You've drawn it
I've
on.
made slight adaptations to my wall.
You've
And
drawn
Okay.
Scotland
Scotland.
is now bigger. It's bigger.
Is
than
that actually
England
Scotland or
and
something
Wales
from Game of
combined.
Thrones?
Well, I think it's a good replica of Scotland. I clearly haven't had time to colour it in, but it's Scotland because it says Scotland.
Okay.
So just to resolve that, and I've also put a little bit of blue tack in exactly where Andorra is.
Yeah. Did you manage to condense France as well, or is that still huge?
No, I mean France is still smaller than now
smaller,
the UK.
is it?
Now, yes, UK, and now the UK combined. Now we've got Scotland in there as well. It's just so much bigger. So I just wanted to clear that up because I did get some criticism from some of our watchers.
I
So
did
there we
watch
go,
the
resolved
previous
that.
one, and I felt like I'd stumbled into a remake of Game On. To be fair, at that point, so
Game
one
On.
for the more mature people to
That's
remember.
okay. That could have been worse.
Yeah, it could have been much worse, to be fair. Much worse. Goodness me.
The fact that you watched, Martin, I think that's absolutely awesome.
Yeah.
You told me to.
You're the
I did tell
viewer.
you to.
Thank
Yes, you're
you.
absolutely right, and sent you the link.
He does one charitable deed every week, and that was the one. Welcome back, Lee. So great trip in Switzerland. It was Switzerland,
it's
wasn't it?
fantastic. Switzerland, yeah. After the failed attempt at the first time round with the German retired couple in their RV that decided to reverse up our bonnet, we went again. It was great. I really enjoyed it. Really, really enjoyed it. There's a lot of tunnels in Switzerland.
There's a lot of
Never knew
tunnels. It's because there are a lot of
Lots in
mountains.
Italy as
Lee.
well.
Well, I was going to say, a lot of
Interesting fact
mountains.
here. We were Googling it while we were out there. The average tunnel maker or bricklayer or whatever you want to call them out in Switzerland earns £70,000 a year.
That's a lot of digging.
Unbelievable that is, because there's so many of them. They're pros, see? They're paying well.
Mm-hmm.
Well
They had a lot.
constructed. So I've left a few CVs there for, various brick-making companies to get in.
Is there a shortage of properties in Switzerland? I mean, did you Google that? Maybe that's one to talk about
I
next time.
didn't
Because
Google that.
if there's the right tradesmen to build the properties, unlike the UK, if there's, it could well be that they don't have a housing shortage.
So you didn't do
Could well
research
be. My son
on
picked
the
out a
Swiss.
rather nice place that he'd like as a holiday home.
Mm-hmm.
That's good.
Just the 5 million, I think it was, just overlooking the river. That was lovely. A little bit out of my price range there, but thanks for pointing out, son.
For now,
Do you want to
Lee,
save
for
up
now.
for that one,
Yeah,
Lee?
exactly.
That's
Just a bit-
impressive, Mike Monts.
It is. This is like a
Oh, it's a
professional.
very big one, Lee.
Yeah, it's a
Look
lovely
at
one.
that. Look at that. I've actually got Mike envy. Actually, I'm not going to show you.
I'm going to tighten it up. I'm going to tighten my screws.
Yeah, that's it. Screw it
Martin's
up,
thinking, what have I let myself in for here?
What am I doing here?
Listen,
I should have
look,
watched all the
this is
episode really
actually
quick
the-
before I said
This
yes.
is the whole podcast. It doesn't get better
We've-
than this.
Yeah. We've got to go quicker because Martin's back to his call centre job straight after this. So he's taking those
Absolutely.
Amazon.
I've only gone out for an apple.
Do I need to show Scotland again? I thought we'd.
Yeah, okay. So before I start
because
my
I think
introduction,
I've made a big effort there.
I think we should start. I
Did you
think we
trace
should
it?
start.
Did you trace it off a book or something, or
No,
have you freehand?
I looked at it on the screen and I did a freehand. I was going to cut it out, but I don't have time, basically. So that's.
you did
as
that
much as we
freehand.
got.
You're actually quite talented, aren't you?
In many ways, Paul.
Oh,
I'm also grossly
impressive.
misunderstood.
She is.
Yeah. I think that's all
I
of us
haven't
on this call as
understood her
well,
for
apart
years.
from our guest, of course. Anyway, ready? Welcome to the Mortgage Mingle podcast, where we chat about the latest in the mortgage industry, share a few laughs, and maybe even ruin a career or two. Today, we're thrilled to have Martin Reynolds, CEO of Simply Biz, with us. Despite being told he'd never make it with his accent, Martin has proven everyone wrong and now leads one of the country's top financial services companies. He'll be sharing his journey, insights, and perhaps even a story or two. So make a brew, sit back, and enjoy the show. Welcome, Martin.
Thank you. And you've been digging a little bit to get that intro, haven't you?
He did so much research.
I do my research.
So much research.
Wow.
Copious.
And I thought this was just thrown together for.
That's how it's made to look. Okay, that's the art of it.
Yeah.
That's the art of it. Anyway, let's start as we've got Lee back. Lee, what's going on with those swap rates?
Well, a bit uninspiring, to be honest. Very similar to England's performance on Friday. There's not really much going on. There was a little bit of a dip at the end of last week, but just having a look, as of about 2 o'clock today, 1 year swaps are still floating around 4.94, still suggesting one cut over the next 12 months. 2 years are up again at about 4.65, and 5 year money is back over the fours again, sitting at 4.128. So thoroughly uninspiring at the moment, Paul, to be honest with you. I was hoping a few days away I would come back and just see them all going low in the reds, but far from it.
And we've got some more data this week as well, haven't we? The Rick's housing survey's out on Thursday. That might make a difference. And then the labour market data is out tomorrow. So again, it might make a difference if there's some positive upturns in those, but I fear not.
It's thoroughly uninspiring, to be honest with you.
Yeah. Meanwhile, it's all gone off in Europe with the European elections, and that's probably why you've seen 5-year gilt yields rising. The French have done Macron's done a Sunak, hasn't he, and called a snap election. So
France might get even
very
smaller
confusing.
on my map.
France might get smaller on your map. You might even have to erase it from the map.
Europe.
Yeah, it really is. It's crazy. And I think from a macro perspective, when you look at the American markets as well, because there was this all talk about the American interest rates coming down, and then that would cause us an issue here because we would take longer to come down. So that was, I think, influencing the markets as well. But with all the fun and games that have been thrown in with various elections, including our domestic one, you can't predict anything, and you've just got to keep doing the day job and look at one day at a time, I suppose.
I think so, and I think, but I've also said that's the beauty of being a mortgage broker, is if you've got that much confusion and change and challenge happening in the macro environment, then the consumer is always going to want some advice, something to talk to, someone to talk to, someone to guide them.
Yeah,
I think that will tie well into what we're going to talk later on about with respect to Santander reducing their offerings from 6 months down to 4. But coming off the back of a week where there's been pretty much an awards due every day last week. You know, we're out seeing a lot of other brokers at the moment, speaking to a lot of other brokers, and it's flat out there at the moment. It's really, really flat. And I think a lot of that has come from this volatility that I think I said it last time we were on. I've never known such peaks and troughs in the industry over the last 6 months from January. 1 minute you think you're flying, and the next minute everything disappears, everything stops, the phone stops ringing. You're sending yourself emails and calling yourself to make sure your phones and emails are working.
Testing.
And then it goes off again. But I do love an awards do, as people know. I do enjoy an awards do when I go out there. But what I love about it most is you just get to speak to all the other brokers that are out there. And everyone seems to be experiencing the same thing. There's so much volatility, confusion about where the market is going and what rates are doing. But it seems like everyone seems to have down tools a little bit at the moment. And with the Euros starting on Friday, then you've got the election in July, then you're going to be about 2 weeks away from summer holidays when they kick off. The general consensus is not much is really going to happen until September time. And when you look at that, you just...
Are you advising your fellow brokers to just down tools and start again in September? Just take time off?
No, I mean, you work your book, don't you? You work your book, you look through what you've got, you look at your rate roll-offs, but as lenders start to reduce that offering from 6 months down to 4, because as we come on to that, I do think that's going to knock on to other lenders as well. You'll start that window of opportunity.
Yeah, so let's talk about that. And also, are you seeing your clients saying to you, look, I just want to hold on because rates are definitely coming down, so I don't want to do anything now. Are you getting that sort of feedback?
Yeah, we are. I think you touched on it last week when Rachel was on. You are, but you've got no idea where the market is heading at the moment. So you've got to play with the cards that you're dealt with right now, I think, and you've got to book in early. And then subsequently, as the pieces move, you'll end up changing further down the line. But the key thing is, as far as we're concerned, is start that relationship at the most early opportunity as possible. So when you've got PTs contracting from 6 months down to 4, that actually gives us a little bit of a head start because we're still speaking to the client 6 months ahead. You're positioning where you are, you're looking at what other lenders are doing, and you can potentially start the process there. And then 2 months down the line, you then look at the PTs and you start reviewing the PTs. And I mean, you've mentioned this before, Louisa, that churn, I still think the churn is going to be big. Whether that churn is going from PTs or whether it's going from swapping from a REMO to a PT, that 6 month period is still going to have a lot of activity in it, whether you reduce that PT margin from 6 down to 4 or not, because we'll just go to the rest of the mortgage market and see what remortgage options are available. So unless you make the remortgage offers 4 months as well, it's still pretty much the same, really, as far as we're concerned.
Yeah. So explain exactly what's happening though before we carry on the conversation. What exactly is happening with Santander?
Well, they've reduced that option to get a product transfer. You can access your product to get a new product transfer as of this month from 4 months. It used to be 6 months. You could go in, you could activate the switch, secure your offer at 6 months, and then watch that rate continuously as it goes along until you come off your product. But what Santander
what was
has
the
done
explanation?
I think it's just the fact that they're so
what
busy
did they tell
with
you?
churns.
But did they come out and actually tell you the reason why, or is that just your interpretation?
I think that's my interpretation. I didn't actually.
About
I mean, Mons, did you see it?
Yeah, I mean, lenders have been talking about it, haven't they? Yeah, go on, Louisa.
We've been lenders have been talking about it behind closed doors for a while. But also, what's quite interesting is I had a quick recce of just where all the lenders were sat. And actually, those lenders that are at 6 months are now outliers. So if you have a look at most of the lenders, they're sat at 3 or 4 months. So actually, Santander have not led the march. They've joined the march because it was already at that. And some lenders are still at 3 months. So they're actually, the ones that are now sat at 6 months are outliers. And I suspect that the reason why they're still sat at 6 months is because they've got systems constraints. So they can't make those IT changes because it might sound really simple. But if you're having to rewrite all of your documentation in the background and the letters that go out to customers, etc., it's actually quite a big piece of work. So I suspect that the reason why the ones that are left out at 6 months now are left out because not through choice, but simply because they've got IT constraints. So I suspect ultimately the market will land at about 3 or 4 months.
Yeah, I think it will. There's still a discussion amongst some of those lenders as to. So we were at an event last week, and that was one of the discussions. It was a big top 6 lender. Should they go down to 4 months, or should they stay at 6? And even within the room full of 50 brokers, it was pretty split, where a lot of us were saying, actually, yes, you should go back to 4 months. It's difficult for lenders to price. You've got all the churn issues. And actually, I can see clients actually losing out if you stay at 6, ironically. You've also got to remember that when the mortgage charter came in, the terms of the mortgage charter are it should be up to 6 months. It doesn't have to be 6 months. Yeah. So there were some lenders who, as Louisa said, for IT reasons, could never move. They couldn't change to 6 months. And the top 6 were basically pretty much told by government that they had to move, and so that's why they did move. But it hasn't really worked, I don't think, as anticipated. I think if you're going to help people who it's fine in a real rising market, then it's very helpful. In a falling market or a potentially falling market, then it causes loads and loads of problems for actually clients as well as brokers. So I think over time,
and let's be honest, a lot of these changes are marginal.
Yeah, correct.
A lot of these changes
they're really marginal
as well. So it's going to take a big swing on the swaps to activate some big changes, obviously, and various other bits and pieces. But I still think you'll know better than me, Louisa, but I still think lenders are a little bit scared to be topping the leaderboards at the moment and taking loads of business. And I feel there's a bit of a fear factor from lenders to want to sit at the top and then taking a load of business, knowing that in 2, 3, 4 weeks' time, products could come in that are going to be significantly cheaper, especially if we end up getting the cut, which actually, let's be honest, looks more and more unlikely as we go along. There's going to be a cut in June. I think it's going to be a lot more likely we'll see that kind of September time, maybe. Who knows? But no one really wants to sit on the top of the leaderboard and then just suffer a whole lot of churning going on at the moment. So
you're absolutely right, and I think what you might see is some of the lenders that really enjoyed a really buoyant start to the year are the ones that are now going to sit on the hands because they've got a very healthy pipeline that in effect could churn. So if you think about it, you could lose 30, 40 basis points. If we see a drop in swaps, you can lose 30, 40 basis points overnight on a sizable chunk of your pipeline. And if you've already hedged it at a higher rate, you're just not going to want to do that. So actually what you're better off doing is potentially sitting on that pipeline, letting it work through, and then come out with your repricing at a later date in the year. So I think what you might see is some of those that were really, really busy, sitting on the hands and not necessarily doing much by way of repricing. And those ones that were relatively quiet at the start of the year, and we all know who they are, those are the ones that are potentially likely to come out with some more sexy products because, of course, there's nothing to churn. So I think that's what you might see. So that dynamic might change very slightly. Ultimately, the customer misses out because they've got less choice in the market as a result of that churn activity.
Yeah.
So again, we talked it to death, but I think that is the reality of the situation that is likely to play out in a falling rate environment. When rates go up, it doesn't matter, it's fair game. But in that rate where you see a falling rate environment, I can only see that's the way that the market's going to play.
Martin, what's your view?
I think picking up on those points, I think that the interesting bit for me is I think by moving it back to 4 or 3 will make the pricing more stable potentially, because at the moment, as you said, Louisa, every time there's a rate drop, everybody follows it down, and if people have been buying tranches, then they're going to have to start blending the tranches, and therefore the rate actually that they can put forward is probably not as competitive as it could be on the new tranche of money because they've had to actually blend it with the higher rate of the original tranche. And if you're doing that 3, 4, 5 times over a 6-month period, that could mean that actually you could be 5-10 basis points potentially higher than where a lender might want to be on that rate, just to cover the cost of the higher tranches that they've brought.
How do you think, Martin, how is this going to affect like the smaller lenders that takes them longer to reprice? How do you think it's going to impact their levels of business? Because they're not going to price massively aggressively in case it has to be repriced anyway. They don't want to risk that big churn. So do they just sit out and just pick up small bits and pieces here and there? None of the smaller lenders will go aggressive anymore, will they?
No, I don't. Well, they can't compete with the big lenders. As soon as a big lender wants to cut the rate, then it changes the market, doesn't it? I think what you tend to find with the smaller lenders is they will just carry on competing on the criteria, on the quirkiness, on the bespoke underwriting that they will do, which allows them to hold the price, because therefore price is not the key determiner in that position. It's will you actually do the deal? Whereas the big lenders, where it's scorecard, it is very much price driven because you very quickly know that it'll go through.
So in this kind of climate we're in, will you see their market share dilute even more, do you think, because of the way the pricing is?
Sorry, I missed the first bit then, Lee. Sorry.
Will you see their market share dilute even more because of the susceptibility of rate changes then?
No, I think it would depend on how aggressive the high street lenders are, because I think that's where, and we saw that last year where some of what we call the tier 2 lenders took a lot bigger market share earlier on in the year last year because the big 6 weren't pricing as well. But as soon as the big 6 priced, they went back to their sort of normal grouping of a market share. I think the split of the top 6 market share might have changed, but their overall percentage returned quite quickly back to it once they started pricing. They've just got the capacity to process, haven't they, as well?
Interesting stuff. Now, Louisa, you wanted to talk about one of the things you mentioned was the mortgage guarantee scheme.
Yeah, so obviously the Labour Party have suggested that they're going to bring this in as a permanent fixture, which was going to resolve all of our first-time buyer problems. Clearly it's not, because 95% lending is pretty much out there and fairly standard nowadays, and this mortgage guarantee scheme is actually a very expensive alternative to 95% lending. So I just wanted to have a chat about it because I'm not a resi lender, but I get I've got a reasonable understanding of this, but I was keen to understand from from the distributors and the advisors in the world as to whether or not they think this is a good thing, whether Labour have hit the right button or not, as the case may be.
I think it's
Monty?
a start, isn't it? And it's something. So my understanding is generally limited about most things in life, but my understanding is it's the more permanent nature of it that will help. The fact it's not just there for a certain time, that it's going to be permanent, could potentially help lenders get more higher loan to value products out there. But obviously, with all these things, the devil really is in the detail, isn't it? But I think it's just the first start of a whole package of housing policies from Labour. So it'll be interesting to see when they release their manifesto what actually is in there to supplement it. No one's looking at this and thinking, "Yay, this is going to solve everything." But I guess it's how it's all put together Monty, in a package.
Were you part of the group that met with the Labour senior MPs? Was it last year?
Yeah,
I was. Yeah, Monty was there. Yeah.
Yeah.
And what was your view? What was your feeling after the meeting?
So I came away. So I chaired the meeting and I came away with an impression of. So it was Lisa Nandy and Rachel Reeves, and I came away with an impression that they actually understood the market and the problems, which was quite refreshing, because you're never sure going into all these things. Rachel Reeves is, I think, has worked in this industry, hasn't she? Previously, she's a very intelligent cookie and knows her stuff very, very well. And some of the stuff we were talking about was all the stuff that we've talked about in private before, and actually, I think it seemed that they were listening and they did understand. They had their things that they wanted to do from their Labour slant, but it seemed, I think we all received it very, very well. There are a couple of key points. One is, the Tories have had 14 years to come and talk to the mortgage industry and the people in the ground, and they haven't done it. Labour have done it once, and actually they've repeated it with a couple of other brokers around the country already. So that is very promising in itself, because obviously, as Association of Mortgage Intermediaries, we're apolitical, so we'll talk to everyone about what's going on.
Sorry,
in the market.
You're apolitical what?
Was that a gag?
Sorry, I couldn't resist. It wasn't funny.
Are you gonna edit in a little drum roll? Ka-ching.
Yeah, I'm here all week.
He's here all week.
Really am.
Next week, the Bournemouth Pavilion.
Yeah, no.
I think you're right, Monty. I think on its own, it's sort of, so what? It's a good headline for people who aren't in the mortgage space, maybe.
Yeah, that's what I was thinking.
Yeah, absolutely.
As a consumer, because it sounds really good. I think the fact that it's permanent is the positive from it, because I don't think it's needed at the moment. But we know the mortgage market's cyclical, so if something happens in 4 or 5 years' time, it's there, isn't it? And you haven't then have to go and start the process of getting something done. But in isolation, it's not going to move the dial at all. It'll just be interesting to see, as you say, what they supplement it with. But the only risk is not supplementing it with lots of schemes, and then it becomes too bitty and too hard to manage and work through, doesn't it?
Yeah, the Conservatives are saying that they're going to ditch stamp duty for first-time buyers. So is that a better result?
But the problem is here, none of this is helping us in the mortgage market at the moment. It just means everyone is down tools and they're waiting for the election. Yeah. So, we may as well pack up and just go and watch the football.
Well, you see, I slightly go on holiday again.
I slightly disagree with that, Lee.
That's what you've got.
No, he hasn't.
What do you think?
I think, Lee, this is you're trying to persuade every other broker to go on holiday so you can clean up.
I'm not the only one.
Is the only mortgage broker available?
It's only Lee. You see, if I'm a consumer now, I'm buying now. Why am I waiting? The last thing I do is wait until a new government of potentially a different colour comes in, where all the bad policies, they're going to get out the way first. And if everyone is waiting, or put it another way, if everyone is waiting to see what happens and the election comes, and let's face it, it's not going to be a massive change because they're all quite centrist parties now, the two main ones, then there's so much pent-up demand that if interest rates do start coming down, then everyone's going to pile in and house prices are going to rise again. Yeah. So all those people waiting are actually going to end up paying more in house prices.
Of course.
Now is the time of the first-time buyer, 100%. It has been for about the last 3-4 months. When you've got that competition removed from landlords coming in who just are not buying right now, they're not interested. People are still doing their maths thinking, I'm not sure if I can afford it, I'll wait for the cut. This is the time of least competition to go in and get yourself a bargain.
And I've got to say, that's a really... So I was just going to say, Monty, to your point, that was really interesting because I hadn't thought of it that way, is that if, as predicted, that Labour get in with a massive majority, they can then do whatever they want. So the really difficult policies or the unpopular ones, they can just get in and get out the way.
You've got to do it first.
What you sort of alluded to.
And what do we need? We need money. We need things that will give them money so they can actually fulfil their real agenda. It's the same with the Conservatives. Don't buy all the crap that they're talking either. They're going to have to do the same thing. And the difference is from where I look. I'm full cards on the. Everyone knows I'm a champagne socialist, so there's my political persuasions are left of centre, but there's only one party who's talking about supply side issues and supply side medicine rather than demand sided, and that's a problem we've had from the Conservatives over the past, sounds like party political broadcast now, over the past few years.
Andrew Montlake
everything they've done has been demand led. So they've kept stamp duty down, and look, stamp duty to first time buyers, you don't pay it up to 4.25 anyway. So that's a huge percentage of first time buyers if you look countrywide, when the average house price is nowhere near that. So a lot of first-time buyers aren't paying stamp duty anyway, and all they've said is they'll just keep that 4.25, which might be what Labour does anyway.
So a bit of trivia, okay? As you mentioned earlier, all the hours of research that I put into putting this together. January the 1st, 1974, what was the base rate?
7%.
To say, Paul, I wasn't born then, so I'm not sure.
I know.
You can remove
1974.
From my cart, I'd say it was about 8.5.
You're going 8.5. Any advances on that?
I'd say about 9%.
13%. January the 1st, 1984. See what I'm doing here?
17%.
It's before 12%. That happened, if you remember. So 9.06%. January the 1st, 1994. The good times. Actually, it was that was sort of the end of the. Was it the end of the .com thingy?
6.5%.
Not bad. Any other advances on that? 5.13%.
Wow.
January 1st, 2004. That was when Martin was rocking it up. There was it the Burn Mid before the Dallas days or whatever.
It was
about
3%.
No, it was 5.25.
Yeah, it's about
3.75.
Oh wow! Louisa.
January the 1st, 2014.
0.5.
Well done.
Oh, wow.
Spot on.
Yeah.
0.5. And January the 1st, 2024. We all know. 5.25. Anyway, that was quite interesting, wasn't it?
Not really.
That's about a minute of your lives you're never going to get back. I must do that again for the next one.
Let's try another one next time.
You got to do more to impress Louisa, Paul.
Oh, yes, I know. I've been trying that for years.
What's really impressing me is I'm in York and it's been raining all day, literally all day. And now, at this pointless hour of 5:10, the sun's come out.
Pointless
Great.
out.
What am I
Have
going
you
to
got
do
your
with
chocolate
that?
Brazils, by the way, or whatever they were? Chocolate almonds. Have you
Oh, I've
bought
gone
any more
through
of them?
those. Went through
I'm
those
eating
ages ago.
peanuts.
I've not ordered any more because I ate too many of them.
Yeah. Okay. All right. Well, we're going to speak to Mr. Reynolds now because we have mortgage royalty on the show. For those who I can't believe there would be anyone that wouldn't know who Martin is, but for those who don't, Martin is the CEO of Simply Biz, a leading provider of compliance and business support for financial advisors and mortgage brokers. It says here, his career path is a true testament to hard work and perseverance, rising from humble beginnings to the top of his field. So there he is. Welcome again, Martin. So Simply Biz is a mortgage club, right?
Simply Biz Mortgages is a mortgage club.
Simply Biz Mortgages.
Thank you.
Okay.
You've just given me my boss's job with that first title, but I'll take that. I'll take that until he watches it.
Are you not okay? So you're CEO of Simply Biz Mortgages.
We are kingmakers.
Okay, right. I'm not going to cut that out.
I want to know who writes these scripts because I want to send them some money. They're really
All
nice.
starts
Very
here.
kind of you. Yeah.
But okay, so Simply Biz Mortgage Club. So what does a mortgage club actually do?
That's a good question and one that a lot of people tend to ask us on a regular basis. I think for us we're a conduit between the lenders and the advisor community, and I think we've been built over time for a number of reasons. One, because lenders want that help to get out into the directly authorised market and have people that can bring together the smaller advice firms to help them get in front of them rather than having to try and work it themselves. But I think where we look at it is we work on what we call our pillars of success that we face out to our members and or out to our lenders, and three of them are the same. So it's all about how we can help them save time, how we can help them reduce risk, and how we can support their growth, whether it's an advice firm or a lender. And then on the advisor side, our fourth one is how we can help them increase their income, and that's ancillary sales, looking into new markets, helping them with lenders. And then with the lenders, it's how we can help them succeed together. So understanding their objectives and helping match those objectives with the right firms in the market. And that's all down to training, education, the backdrop of our compliance propositions, etc. So I think it's a two-sided coin with us. It's how do we help both sides of that coin to get what they want.
And do you find different personality types would go for being directly authorised broker as opposed to an AR?
Yes, I think is the simple thing. I think, well, if you look at, we've all got different personalities, and I think even if you just look across the network space, somebody would join a certain network because it has a business model that looks a bit like the business model that they want to build. Because not all the networks are the same. They're not linear in that respect. So I think, but when you do get into the directly authorized space, I think it is a lot of it is around that wanting to build something the way they wanted to do, want to have the ability to change how they focus and the areas that they go into when they want to. Probably I wouldn't say more entrepreneurial because that's a bit unfair because there's ARs in there that are very entrepreneurial, but I think it's people that are very quick to change and people that like to feel as if they're controlling their own destiny a bit more.
Being a mortgage broker doing it properly is quite a daunting job. Doesn't matter if you're an AR or a DA, but being directly authorised by the regulator is clearly a daunting task. And I've done that in the past. Do you actually provide? Is it some sort of subscription that's paid, and people then get access to your compliance teams, etc.?
Yeah, I think that is, and I think we're all different. Some clubs do, some clubs we all have different things. Ourselves, yes, ultimately we started off as a third-party compliance provider, service provider, as they're known in the IFA space. So yes, if somebody joins and uses the mortgage club, then they also then have access as part of that membership to our compliance proposition, which gives you templates, gives you the tools and the tracks to help you build your business and know that you are compliant. And then it also gives you the comfort of a lot of people in our policy department who are watching anything that the regulator or any of the trade bodies or anybody of relevance relevance within there is doing, and then can feed that back out to you that says, actually, you may or may not have seen this 325-page paper that has come out from the regulator, but this is what it means. This is what it could mean to you on the changes. And by the way, we've changed the documents here and here that will help you recalibrate your business to make sure that you're still compliant.
On our DA side, we actually use Martin. So and they've been very, very helpful, especially through things like consumer duty, which has been very helpful to have someone else to talk to about that.
And you speak to Martin directly about that. That's great service, Martin. You do that with all your thousands of.
No,
Martin
never picks up the phone to me. But yeah.
Ever since he took my last job, yeah.
You couldn't wait to give me that job.
I was going to say, I thought you'd gifted it to him, Martin. I don't think
of course. Gifted. Yeah, of course. Yeah. So how long have you been at Simply Biz now? It's quite a while, isn't it?
Yeah, it's 12 and a half years now. So, lots of changes since we've been there, yeah. So,
and we were chatting the other day, weren't we? And you know, this 12 years on the other side of the table, because pretty much the rest of your career was as a lender.
As a lender or as a provider. I started off in the insurance market for 8 years. So underwriting MIG policies, for those old of you to know, before I left the insurance world.
People of a certain age will all be listening.
Good old MIGs.
Oh, MIG. Yeah. Let's talk about Myris as well, shall we?
Well, when I went on to the lending side, Myris was still there, yes.
What about double Myris?
They should bring back double Myris. I loved a bit of double Myris.
I totally agree with you. 100%. Myris used to give me sleepless nights because as a junior starting out my career, having to fill these blooming forms out that were in triplicate had to be perfect. Right? You weren't allowed to cross anything through. So you would, you'd be 2/3 of the way through this form and then make a mistake. And then you'd have to rip it up and start again.
Mm-hmm. But it moved on quite swiftly, didn't it? Because you could actually print them. You were able to put them through the printer as they progressed.
That was
might not have been in your time.
I didn't have that. I didn't have that facility.
I think for me, where I'm looking at it is I think we need to step back, and it's a wider thing of without sounding lender bashing, is looking at. It's a partnership, it's a supplier relationship. And if we look back probably 20 years ago, when we started to see conveyancing fees get squeezed a little bit by procurement, and then obviously the levels of service have been a bit hit and miss, shall we say, on conveyancing, especially on the free legal side of it, where ultimately there was a big fee, but then the actual conveyancer might have been making £18 out of that, and that included having to cover their PI. So again, you get the service at the price, and we've seen a little bit of that happen in valuations over the last few years as well. So for me, it's just making sure that it's not just about PTs. Those fees on conveyancing and valuations have been squeezed. Prop fees, full stop, haven't moved in 20 years. So you can, in fact, they're actually going down. So then to have PT fees below that as well. So for me, it's looking at that supplier relationship, because if we take it, a mortgage advisor is a supplier in that supplier lender relationship. And I do worry sometimes that lenders are always looking at cost control, and if we're not careful, that cost control could start squeezing its suppliers, and then actually how they're going to get that business, because we know that it won't come direct. And I think since COVID, that's been seen even more, is that customers want that comfort of somebody telling them that they're doing the right thing. So I think we need to be mindful of not just focusing in on PTs, but looking at the wider picture around prop fees per se.
Why do you think that is, Martin? Why has prop fees not been reviewed in terms of where they sit for about the last 10 years, 15 years?
I think there's a number of things. If you look at the big lenders, for example, and their first two, the two biggest things on their cost line will be their own staff and their premises. And you'll probably then find that procuration fee budgets is number 3 of the biggest cost on a lender's line. So it's quite a hard challenge, I suppose, to go and have that conversation to say, I want to move our prop fee budget or our prop fees by X%. That's going to put X million on our budget, and then talk to maybe a CFO and go, and what am I going to get for that? Well, same as you got last year, to be fair. But we just think it's the appropriate thing to do in the market. It's not an easy conversation for our intermediary side of the lenders to have that conversation with their wider group, because it's how do you quantify what that's going to get you by putting that extra on the bottom line. But
do you
at the
think
same time,
is there a reliance there that they just think if brokers want to earn more, they'll charge more?
there is that
Which
to a certain
which
extent. So I'd have thought so, yeah.
it's
I
difficult
think
in this climate.
it is, but similarly, if you kind of look at margin compression, and I'm not kind of now beating the drum for the lenders, but I do think that there's two sides to it. So if you look at some of the lenders' margins and the compression, and we've talked about churn, which I'm not going to mention again, but if you look at the fact that we're trying to all be as competitive as possible, and also make sure that we keep the wheels going for the mortgage market. So you have to try and be as competitive as possible so that you overcome some of the affordability constraints. Then you're going to see margin compression. And going back to Martin's point, depending on the lender, some of them will have it as a bottom line. Some of them will price it into their mortgage pricing. And actually, if you price it into your mortgage pricing, it then impacts your net interest margin and various other aspects that go alongside it, because you've got to think about, well, how much does it cost me to bring this business in the first place? And it's not just procuration fees, but it's things like your marketing budgets, it's things like your sales teams. So you'll have one pot that pays for the originations bit, and then you've also got the underwriters. So how much does it cost me to write this business? How much does it physically cost me to get this business on the books? And then what does my margin look like? How much does it cost? How much is the funding costing? So you've got all of those different parts that then give you whatever your margin might be. And if you're trying to be as competitive as possible to try and work with customers to enable them to get onto the housing market, etc., we're seeing margin compression. And going back to the churn piece, as everybody's churning this on a regular basis, you're seeing those margins erode even further. So I think, and I've mentioned this a few times, as you're quite right to say, Martin, there's a wider conversation to be had. But I do think it's a market-wide conversation that says, what actually is it that we're all trying to achieve here? We absolutely rely, not entirely, but to a big part, on intermediaries. And we want them to be able to earn a good living because we need them to survive. In the same way as you rely on lenders and you want them to make a decent living because you need them to survive. So somewhere along the line, we've got to reach that equilibrium where we're all working in the same way together. And, you talk about customers, for example, and we talk about servicing the customers and doing that really well. And I think that is absolutely key. But how often do your customers ring you to say, have you checked my rate? Have you checked my rate? If that's a regular thing, then, maybe there's an element of managing expectations here that say, actually, on day one, this is your rate, you can afford it. If you want to change that rate at a later date, then we need to try and build that into our pricing strategy, whether that be by way of charging additional fees or whatever. And I know that's not an easy way, and these things have got to change. But I do think there's an element of evolution, but also the two components of this market coming together to try and move it forward in a positive way for all. I'm not sure how we do that, but we talked about it on the very first podcast. Maybe it's something that, as Amy and Imla, we can have those open conversations.
I think it's the bit for me, isn't it? It's not just on the mortgage side, as I said, it's on the others, the supplier side that sits in the middle. Lenders trying to manage its margin and maybe not have the compression. The customer's trying to get the cheapest rate. The advisor and the other suppliers are sat as the squeezed middle, because both sides are trying to, at either end, are trying to make sure they get the best deal, and the advisor sat in the middle, trying to manage both sides of that equation. And as you say, do that. And we've seen that with rate pools and things like that, isn't it? That we know that some customers have felt like it was a heavy sales tactic by the advisor to say, I need an answer within the next 30 minutes because the rate's going at 5 o'clock. Because it's the advisor that is the face out to the customer, because it is that supplier into the lender. And I think, as you say, I think there's quite a few open and frank conversations that need to have around a few of those areas to make sure that everybody can still manage their businesses correctly, but still give the right service to the consumer at the end of the day.
The positive thing is we are starting to have those open and frank conversations with lenders to a degree, and that's really good. I guess, as I said last time, the frustration with brokers going back to your point, Martin, is that it always seems that it's the broker that has to give, whether it's on their fee or their proc fees. Meanwhile, lender fees have continually risen over the last few years, etc., and it always seems to be the broker who has to lose, and that's just not
Very good point.
sustainable.
The arrangement fees have gone up and up and up, haven't they? When you look back on what they were 5, 6,
They're
7
at the
years
highest
ago,
level
but as
ever,
those
yeah.
fees, and as those fees have edged up, what a broker earns in their remunerations remains unchanged. It's a very good point. They're actually
The
thought
thing is,
about that.
it's
but
also
the fees
easier
have
to
edged
do
up to drive affordability down. So if
on
you
buy
think
to
about
let.
In the
so
buy-to-let
buy-to-let,
space.
the fees,
Not
the
buy to
fees
let,
have gone
talking
up
on a
to
resi basis.
okay.
Buy to let's
But the
different.
thing
You
is,
need to
Lee,
do that for the stresses.
the thing is, from a lender perspective, and also because of the way regulation is that when you package up a product and it includes a fee and you've got the ESIS document and everything else, it's the structure of it sort of alludes to that right, this is what it looks like. This is the final product. So therefore, Mrs. Applicant, here it is. With your fee, it's like, oh yeah, it's just an addition. It's sort of, we've had to bung it on the top. And I think that's where, in my view, where it's wrong. Because it's the perception, not only from a broker point of view, but from a client's point of view as well.
It's interesting, isn't it, as well? So I don't think in the time I've been broking, I've never heard brokers more disgruntled than what they are at the moment.
No, agree.
I think there's a lot of brokers that are looking to exit and have had enough and are finding it hard. Mental health is a whole another topic to talk about, but I feel like the mental health of brokers right now is exceptionally vulnerable, probably more vulnerable than I think I've ever known it. And I've not been doing this as long as yourself, Mons, but you'll probably hear a similar thing, I should imagine. And again, that's what's been interesting out of these awards. You go out to these awards and you speak to brokers on there, and just so many of them are, this job's not what it used to be. It's really difficult right now. It's really, really hard.
I used to do awards 5 nights a week. I'm only doing 3 nights a week now. Yeah.
What awards were these then, Lee? I missed these.
That's because you won't go to the awards, Martin.
Oh, that's it.
Yeah.
But I don't know how much of that is earnings related, or is just the frustration of pricing right now. But brokers seem a lot less happier right now than what they have been for a long, long time.
Now, Lee, obviously these are all very sweeping statements. So are there no brokers that you're speaking to at all that you are, or you think that you go, actually, do you know what? They might have cracked it.
Yeah. Do you know what? The brokers that I think have cracked it, I mean, maybe we don't publish this, I don't know, but the ones that I speak to that I think have cracked it are the ones that haven't moved, have been at the same job for the last 20, 25 years. They're at the same company where their client bank is so big now that they're just remortgaging the same old stuff, and they're remortgaging it. It's just compounding and compounding each year. Their book is compounding each year, and they're not reliant on purchases anymore. And it's those ones that have stayed.
Mm-hmm.
I've said this to Mons a few times, you look at where these people are and the levels of business they're writing and what they're generating. When you look back and think, if I'd have stayed where I was 20 years ago and hadn't left, I wonder what I'd be broking right now. And they're the ones that I think have probably cracked it in my eye. They're the ones that are doing well. The ones that have continuously gone on and chased business and tried to go on their own and tried to grow companies, they're the ones that are probably thinking right now, do you know what, this is too tough. This is really difficult. They're the ones that seem to be struggling. But, if you were to, again, you could probably edit this one out, mate, if you want to be honest. But I don't think I've spoken to a single broker that's loving it at the moment. Everyone I've spoken to, this isn't what you want to hear on a podcast, I don't think. But I don't think I've spoken to a single broker who's enjoying it right now.
Well, I've got to say, we are beginning to get a few more people watching this. So,
edit that out then. Edit it out.
Yeah, no. But what I'm saying is that it'd just be great to get some feedback from some other brokers that are watching this, and if any lenders are watching this and disagree with what you're saying and saying, well, actually, that's not their experience. Martin, you must speak to hundreds of brokers all the time. Are you getting similar feedback, or is the feedback you're getting mixed?
I think it's a mix of regional and their product type. Where do they get their business from as well? So I think everybody's saying it's harder, and they feel it's harder. I think the mortgage charter has added to that, as we've already talked about. So I think that moving to 4 months will take away some of that rework, that stress. I think everything just seems to take longer. So it's getting to the stage now where you get an offer accepted on a house, but it's taking nearly 6 months then to get from that stage to moving in. That used to be 12 weeks. So that sort of doubled over the last 4 to 6 years for no real reason. It's every bit in the chain seems to be adding a little bit on. So I think it's those sort of things that are just compounding that there's lots of things. I think we see a lot, and they're still okay and they're still happy, but they're just saying it's harder. It just feels harder. There doesn't seem to be the downtime that they had before. I'm not necessarily they're all working late hours, but even during the day, even if it's just a pure 9 to 5, it's full on 9 to 5, and finding that time to then go towards dinners and things like that at the evening is a little bit harder. But I think it's definitely regional, and I think if for the last few years maybe you've been attached to a estate agency or that's been your core part of new business, that's been difficult. I think, as Lee said, if you've got a mature book, then having that remortgage market or PT market has helped. Won't go on to PT fees again, But yeah, I think a lot of people probably had the last couple of years. I think some people said they had some of their best year last year for pound sign broked, but not their best year for revenue because of the fact that it was PT'd, that they earned more the year before for writing less business because of the mix that's going around.
Yeah.
There's been a huge culling of buy-to-lets. Those that are dependent on buy-to-lets, and that's been a big product mix for them and of stuff they've done, that has really diluted over the last 18 months to a huge level. And that's probably, I don't know, you probably know better than me, Louisa, but I should imagine the product transfer conversions on buy-to-lets is significantly higher than what it is on a residential basis.
Yeah, it's incredibly healthy. You're talking 80s and plus %. But it's we talked about this before. Despite the fact that our retention rates are really, really high, only 50% of them are coming from brokers.
Yeah.
And we pay a healthy proc fee. So I absolutely sympathise with everything. But if only 50% of our customers are deciding and not speaking to their brokers, then what's happening with them? And that for me is a good revenue stream in particular, because we do pay that a decent proc fee on
Totally
PTs.
agree.
So I question a lot of this, because what are they doing?
Yeah,
of that, of the 50% that do come to us through a broker, which we absolutely want, because of course we want them to take decent advice. We then see 40% of those coming through a new broker. So the existing brokers are not looking after their existing customers for a large proportion of our retention customers. So that I find really worrying, and particularly if you look at
stat.
It is a big number, but if you look at our customer group as well, these are all portfolio landlords in the main. So they will be adding to their portfolio or rediversifying their portfolio or doing something. So if the broker isn't looking after a potentially growing portfolio landlord because they're chasing something else that might be relatively small fry that's got a tiny PT on it, or is a new customer that they've rebroken several times, that's the bit that I just think that there's a bit of an eye opener for me, and I do struggle with that.
Does your data go deep enough to tell you whether those brokers are still broking, the ones that haven't?
Yeah, I mean, we could look, because we could just look at the originating broker. We don't, but we could.
I think the other bit for me is just where you're benchmarking yourself against. So if we look at probably the last 3 years, they're probably the 3 biggest years we've had since 2005 in lending when you add in PTs, and therefore, if you go back to probably 2018, 2019, that's probably where we're going to be this year. But it just feels like we're on a slightly downward trajectory because we're coming from such a big high of what's happened with stamp duties, etc., that has created the big influx of 5 years coming off last year and early this year. So actually, if you look at where we are as a norm in the market, we're heading back to what is a normal lending volume. It's just trying to get that mix in a different place. And maybe slightly increase the purchase market. But I still think we're in a positive place. It's just we're coming off such a big high.
Yeah, I would agree. I think it's also quite difficult to get, if you are feeling, really glum, and you're working in a particular way, and your cash flow is not as as good as it could be, it's quite difficult to get out of that situation by going, do you know what, I'm just going to start afresh and see what this world looks like. So, but I do think there's some really positive signs. And I said at the very beginning, our very first podcast, I genuinely think there'll be a lot of remortgage business at the latter part of this year. I think it's going to be a really healthy remortgage year.
You see, Lee, no awards dues at the end of the year, mate. You're going to be too busy.
Yeah. Well, there aren't any anyway, are there? They're all now. It's kind of we're all awards.
No, they're all now. We're in it now.
You can.
Well, there's a lot coming this week. I'm looking forward to Monty's speech on Thursday. Is it Thursday? It is Thursday, isn't it? Have you written it yet?
No, I haven't written it yet. You know damn well I haven't written it yet.
Martin, have you got an old one he can borrow?
Yeah. Similar.
I had a few questions here for Martin, but you might want to use them for your speech, a bit of research. One of them was, why do you do what you do? See, that would be quite profound. To sit there and, with all the challenges and stuff that's going on, to really look inward and go, well, why do I do what I do?
You want me to answer that now, do you, Paul?
Yeah, I do, actually.
Was that a rhetorical question?
Well, it was rhetorical for Monty, but for you,
I'm
Martin,
not sure
I'd
if
love
that was
to know.
accusative or like,
Yeah.
Was that for me?
But I think that's actually quite... It's really... That you can go as deep as you want with that question.
That is.
So, no, you can think about that for your speech, but as Martin's here now, I want to ask Martin, why do you do what you do?
Wow, that is a very deep question for a Monday tea time, isn't it? Well, as per most people, I probably fell into this industry, but then you fall in love with this industry, don't you? You become institutionalized to a certain extent, but then you
it's
do
like
realise
Hotel
that you
California.
actually love it.
You can never leave.
You've never escaped.
Absolutely. But after a while, you just love it, and I think you love it for a number of reasons. One, because the people, how many industries do you have podcasts like this where people that can be seen as competitors and still have fun and enjoy yourself, but at the same time take it very seriously. And whilst we sit in the middle, I still feel as if we're part of that chain that helps people or helps Lee and Monty deliver the dream to customers of owning a house and staying in that house. And I think what's better than there's not many industries where you can actually have that sense of pride, is there, of being able to do that. And
Martin
I think that's
Reynolds,
why it's great, and that's why I enjoy it.
I think that was
Good
the
answer.
perfect answer, a perfect way to end the podcast. So, Martin, thank you very much for joining us. That's been brilliant. Really appreciate it.
A pleasure.